Hello, party people. Welcome, welcome, welcome. Uh, Guys, I'm just going to give everyone 30 seconds or so to jump in. Just while I'm doing that, if someone could please just let me know that the slides and audio are coming through okay, that would be awesome. I can see a few thumbs up. Thank you, guys. That is great. Perfect. Thank you, team. Look, I'm pumped to get into this one today. I think I love this time of year. For money nerds like me, end of financial year, new financial year. It's sort of like for most people, it's New Year's resolutions. For me, it's the new financial year resolutions. And look, there's a lot of different ways to get ahead with your money, but saving tax is one of the only ones that allows you to actually keep more of your income, but without actually sacrificing anything or giving up more stuff or working harder. So yeah, really keen to get into this, start talking through some of the hacks and tactics that you can use to keep more of your income, essentially. A little bit of housekeeping before we jump in, guys. As we're going through today, I'm very happy to get sidetracked with questions. If you've got questions though, and you want to make sure your questions get answered, if you could just pop them into the Q&A box rather than the chat. Feel free to throw any general banter into the chat as well. And I can already see a bunch of people jumping in there, which is awesome. But if you've got questions, you want to make sure your questions get answered, please do just pop them into the Q&A box as well. Also, guys, just want to give a big shout out to our event partner for today, Pearler. Look, if you're not already across Pearler and what they do, they're a platform for long-term investing. We do a bunch of content collabs with them. We don't have like any commercial setup or anything like that. We just know that they do great work. And they are very aligned with us in terms of our philosophy on get rich slow and boring wealth for the long term, as they call it. But often boring is best in terms of being the most profitable. So, like I said, if you're not already familiar with their stuff, you should definitely check them out. Also, for anyone that's here for the first time, and I'd love if you're a first timer, I'd love for you to jump into the chat and let us know as well. I can see a bunch of new names on the list here. I can see a few familiar ones as well, which is great. But if you are here for the first time, we do a ton of different events, content on basically all the channels. So we've got all the socials, upcoming events on Eventbrite. So if this sort of stuff is your jam, then do get around that as well. And look, if you want to dive a little bit deeper into some of the stuff that we've covered today, my latest book does cover a fair bit around tax planning and strategies. You can check that out on the Pivot Wealth website, or basically in all book places as well. All right, final piece before we get into the content, just for the lawyers. I was never here, this never happened. But look, guys, in all seriousness, that if you are making big decisions, particularly things like tax that may have some longer term consequences, we encourage you to seek out advice before jumping in as well. All righty, so look, the first place I wanted to start was talking about financial potential levers, because I feel like this is something that doesn't really get talked about that much. But ultimately, there's a small number of things that you can do to actually improve the financial position that you're in, or the trajectory that you're on with your money. And I've basically got there's 7 things listed here on this list, which are basically the only 7 things you can do to do better with your money. Now, simple things like spend less money right now. If you spend less money today, you're going to have a bit more money left over. That means you've got more money that you can save or you can invest. You can spend less money in the future. That makes your target smaller. It means that you don't have to get as wealthy to be at your target, essentially. So that means that you can get there faster. You can earn more money, so you can increase your income. That obviously gives you more money to work with. You can work for longer. Not everyone's preferred option, but it is an option that's there. Pay less tax, which is obviously the focus for today, and I'll come back to that one in a sec. You can take on more leverage, excuse me, or you can use more risk in your investments, put it all into some specky altcoins. Maybe not the preferred strategy, but it is one that you could do, and if it does work, then you could make more progress as well. Now, Of the things on the 7 items on this list, paying less tax is essentially the only financial potential lever, the only thing that you can do that improves your trajectory without you actually working harder or working for longer or sacrificing today. And so it's really powerful. And look, I get that tax is important at some level, but in my opinion, you don't want to be paying any more tax than you need to. And in my opinion, and this is just my opinion, but I don't think, like, as I think Kerry Packer put it the best in his sittings, those infamous sort of sittings from back in the day, that it's not like the government are doing such a great job with our tax money that I feel like we should be giving them more of it. That's my opinion. But today, what I want to talk about is what are the things that you can do to legally reduce your tax bill to make sure that you're using the rules to your advantage, and ultimately that you're keeping more of your hard-earned income so that you can get ahead faster. But look, I get that it's not necessarily an easy thing, particularly around tax. And I know that there's a few different challenges that people face when it comes to this stuff. I know because we're talking to hundreds of people every single month about what they're doing with their money. But the three big ones that really hold people back, and the three things that we're going to cover today, is the first thing is the rules are complicated. The tax code is long. It can be a little bit confusing, a little bit hard to interpret. There seems like there's a lot of unknown unknowns when it comes to tax as well, that you don't really know what you don't know. And then the third one is that good help is really hard to find. It's sort of a little bit confusing. There's been a big change in how the accounting markets actually work, how accountants work with financial advisors, who actually helps you with your tax. And what we find is for a lot of people, those three challenges, particularly around tax, leads them to end up stuck. And it's often not stuck doing nothing. Often people are just stuck doing whatever the same stuff is that they've been doing in the past. And what that means is that they're often missing out on the opportunity to be getting more out of the money that they've already got today. And so what we've found is that there's actually three main areas that you need to get right if you need to nail it with your money. And that's the three things that we've got up on the screen here: your structure, your strategy, and the solution. So structure is all about making it easy to save and manage your money, and making it clear how much money you've got to work with when it comes to your saving and investing and your strategy. That ties in with the next piece, which is around your strategy. And that's understanding the different pathways that can take you from where you are to where you want to be around your tax and tax planning. Things like, using negative gearing strategies or debt recycling, or using tax effective vehicles like trusts and companies and those sorts of things, as well as just your general investing strategy. So do you buy shares? Do you buy property? Do you pay down your mortgage? Do you do some sort of combination of the three? And then the third element is the investment solutions and the products that you use to back up your strategy. And here you want to make sure that you're making reliable, consistent progress over time. And importantly, that you're avoiding the chances of downsides and setbacks and those momentum killing mistakes. So today we're focused in on tax and what you can do to cut your tax. But you should know that there's actually these three areas, and you do really need to get all three of them right if you want to really nail it with your money. Because if any one of these three areas is missing, it doesn't matter how awesome your tax strategy is, it will end up dragging down the other things that are going on with your money. If you don't have a good structure in place, it's like you're working with a leaky bucket. So you're going to be missing opportunities. It's also going to be really hard to even plan well around your tax strategy, because you don't really know how much money you've got to work with. If you don't have the right strategy in place, well, you're going to be leaving a bunch of money on the table. If you don't have the right investment solutions in place, you're going to blow up your cash, and that's going to be a big problem as well. So there are three areas. You want to be focused on all three if you want to get the results that you want with your money. All right. So I want to start by talking about tax basics and the really simple stuff. I'm sure that a bunch of you guys probably know this already, but essentially I want to build from there and start with the building blocks, and then get into some of the more advanced tactics and the things that you can do to actually reduce your tax. So The first thing that you want to be aware of is that in Australia, we work under a marginal tax rate system. So that means that there's different brackets of income and then different tax rates that apply on that taxable income. Now, excuse me, you only get one tax rate. This is something that confuses quite a few people, but there's essentially one tax rate that applies on all of your income from all sources. So you've got your employment income from your work, bonus income, overtime income, commission income, rental income on an investment property, interest income on a bank account, dividend income on a share portfolio. Basically, when you do your tax return at the end of the year, the ATO adds up all of your income from all of the different sources, and you get one number, which is called your assessable income number. And that income number is the number on which your tax rates and the tax dollars are actually applied. And so these are the current tax brackets that we have in Australia. Basically, the first tax bracket is income earned between $0 and $18,200. And the tax rate that applies on that income is 0%. You don't pay any tax on the first $18,200 you earn. That's called the tax-free threshold. Then you've got 18,000 to 45,000 and a tax rate that applies 45 to 135, 135 to 190, and 190,000 plus puts you in the top marginal tax rate, 45%. Plus Medicare levy, which is another couple of percent on top of these numbers as well. And so this is really the foundation for all of your tax strategy, and it also outlines the value to you of $1 of tax deductions or $1 of taxable income, an extra $1 of taxable income. Now, one thing that confuses a lot of people is that, and I've got this in the myths and mistakes section as well, is that a lot of people mistakenly think that when they go up into the next tax bracket, that higher rate of tax applies on all of their income, which is absolutely not the case. And so, for example, that people think that when they go from, say, an income of $185,000 to $195,000, then they're immediately paying a higher rate of tax on the income earned in the previous brackets, which is just not the case. If you earn $195,000 or even $1.9 million a year, you still pay 0% tax on the first 18,000 you earn. You still pay 16% tax on the income earned in this bracket. And you still pay 30% tax on the income earned in this bracket, and so on and so forth. And so, if you're there. Okay. Well, sorry, I did just get that back. Okay, great. Perfect. Thank you, team. So essentially what this also tells us is the value of your tax deductions, because if your income is earned, say you're on $150,000 a year, you're paying tax at 37%. That means that every $1 of tax deductions that you get, you're going to get 37% of that back as a tax refund. Or, if you're on over 190,000, every $1 of tax deductions you get back 45 cents in the dollar, essentially. Now, another thing that's really important to understand, and this is where there's a huge opportunity to seriously cut your tax, particularly over the longer term, is that tax rates are different for different entities. And an entity, and apologies for using a bit of jargon here, but essentially a tax entity is anything that has a tax file number attached to it. So every individual in Australia has their own tax file number, and every individual is essentially a tax entity. But then you've got companies, trusts, investment bonds, and even super funds, that these are all tax structures that have their own tax file number, that are their own tax entity. And so the different types of entities have different rates of tax that apply to them. And this is one of the like I said, the big ways that you can actually cut your tax. So investing is really important, But you don't need to own all of your investments yourself. You can invest in your name, you can invest in the partner's name, you can invest in joint names, but you can also invest through any of those entities that I just mentioned: trust, company, bond, super fund. Now, if you invest in your own name, you pay tax at MTR or marginal tax rates. But if you own the same investments through your super fund, for example, the maximum rate of tax that you pay will be 15%. In fact, on super funds, if you've got capital gains and you've held investments for 12 months or more, you only pay a maximum rate of 10% in tax on that. So that tax rate is significantly lower than the tax rate that you pay personally, potentially on exactly the same investments. Obviously, now with super, your money's tied up until you're older, so you probably don't want to be throwing all your money in there. But you can see from this that the tax rates are significantly more favorable. You can also invest through a company, and when you invest through a company pays a flat rate of tax of 30%, which again is significantly lower than the top marginal tax rate. Then we've got bonds, so investment bonds here, and I'm not talking about like investing into government bonds. I'm talking about there's investment accounts out there called investment bonds, which is essentially like any other investment account, except it works like a company in that the income is taxed at a maximum rate of 30%. And with a bond, if you hold the investments for 10 years or more, you don't pay any capital gains tax on the growth that you get on those investments as well. Then you've got a trust structure, and with a trust, you basically a trust owns assets and needs to distribute its income to what we call beneficiaries. But then those beneficiaries pay the tax, and beneficiaries can be people, but they can also be companies and other tax entities that can allow you to cap your tax as well. Now, just to show you exactly how powerful this can be, I've got an example here talking about building up investment income in your own name versus through an investment company. Now, a lot of people that I talk to about this stuff, that they may be, still sort of in the relatively early stages of building up their investments and may not have a lot of investment income, but it's worth noting that your real goal as an investor is that over time you want to replace your employment salary with investment income. And so if by definition, if you're going to replace your employment salary with investment income, then you're going to build up tens of thousands of dollars, maybe even $100,000 or more of investment income every single year. And if you're receiving all of that income in your own name, you're going to get pushed well into the top marginal tax rate quite quickly. And you're going to end up paying a lot of tax. And so in this example, I've got here showing, for this one, $100,000 of investment income. If you're earning that in your own name and it's taxed at the top marginal tax rate of 47%, you're going to pay about $47,000 a year in tax on that income. If you're only paying tax at 30%, which is what you get through an investment company or even through an investment bond, you're only going to pay $30,000 in tax, which means that there's a difference of $17,000, and that's every single year. So every single year, you've got an extra $17,000 that you can then reinvest to build your investments faster, or you can spend on your lifestyle today, or some sort of combination as well. So you're talking about a really significant saving from just owning the right investments in the right entity. You can also see that if the income is higher, $200,000 a year, that tax saving is actually $34,000 every single year. 300 grand, it's 51,000. 400 grand, it's 68,000. And so, the differences add up really, really quickly. And so, look, for PAYG individuals, or what I mean by this is employee individuals, then it's really when you're investing money, that's where there's the biggest opportunity for you to save the most amount of tax. I am going to talk about the things that you can do to pump up your tax bill in this year. I'm going to jump into them in a second, but you should know that those things are really playing at the edges, that if you want to be saving hundreds of thousands of dollars of tax over time, and if you're really serious about creating real financial freedom, you're probably gonna need to with the cost of living. And so how you invest your money is the biggest opportunity here as well. Just got a question here, a couple of questions actually. And guys, if you've got any questions, keep those coming through into the Q&A. Bridget says, is that the interest you get from your investments, i.e. the $100,000? Yes, correct. So what that is that if you've got investments that are generating an income, which it would be in the case of, say, a share portfolio, the dividend income that you're receiving, that income is 100 grand a year of dividend income, essentially. Hope that makes sense. Let me know if there's a follow-up question there, Bridget. Got another question here, says, are there any tax saving tactics that don't involve the purchase of an investment property? Yeah, there absolutely are. Exactly that stuff that I was just talking about there. That's exactly that doesn't necessarily need to involve property. It can involve property in that you can purchase a property through a trust or even through a company, and that will have a big impact on the tax that you pay. But for share investments, you can do that through trusts or bonds. For crypto, you can do the same as well, essentially. One here from Santosh says, tell us more about the company setup with the 30% tax. Yeah, so look, in Australia, anyone can set up their own company, right? People most commonly set up companies to actually run an operating business. Like when I set up Pivot Wealth, I set up a company, and then that employs people and delivers services, and that's an operating business. But you can set up a company solely for the purposes of investing money. You basically, any accountant can do this, and you can probably do it online, although I'm not sure exactly how to do that, but confident it could be done. That you once you set up register a company, you then get a tax file number, and once you've got a tax file number, you can then go and open up a bank account, open up an investment account. You can buy property, you can even take out mortgages, and you do it all inside the company. And then at the end of the year, that company just does a tax return. So it adds up all the income and finds that all of the expenses, gets the net income. And basically in a company, but for an investment company, the companies are subject to a flat rate of tax of 30%. So that you don't really need to do anything other than set up the company and invest through the company in order to get access to that. Guys, I can actually see a bunch of questions coming through in the Q&A. I can also see a bunch of questions coming through in the chat. Guys, because we do have quite a few people online today, if you do want to make sure that your question gets answered, pop it into the Q&A box. It's just down in the control panel somewhere under Q&A, just so I make sure that nothing gets mixed. Yes, the session is being recorded, and we'll share the recording out as well. Brent says the 17 grand tax saving would be less due to the marginal tax rate. You'd only pay the highest marginal tax rate if on a high salary. That's 100% true, Brent. But the thing to keep in mind, this is the sort of the point that I was trying to get at, where if your goal is to replace your employment salary with investment income, what you're going to be doing is you go through this period where you're going to be earning a salary from your work. And the average salary in Australia, depending on exactly how you measure it, is, let's call it $80,000. And then you want to replace that salary. So you need to be building another $80,000 of income, maybe more depending on what your goals are. So you're going to basically be at the top marginal tax rate by the time you actually build that income. And a lot of people, they start investing, they don't think too much about the tax consequences because their investment income is really low. But because of how compounding works, you build up all of your, you use compound interest to build your assets. And then all of a sudden, you've got all of this income coming through, which is not a problem because it's great to have all the income, but you start getting hammered with tax. So, you will quickly end up in the top marginal tax rate if you do want to fully replace your salary with investment income, which is what I believe that everybody should be aiming to do. In fact, I believe that it's the true definition of financial freedom, essentially. Sylvia says, can you set up or invest through a trust as an individual? Yes, you absolutely can. Yeah, it works just the same as a company. It's just that with a trust, you need to distribute the income of the trust to another beneficiary. And a beneficiary can be an individual, so you can distribute it to yourself. Although there wouldn't be a lot of benefit in doing that if you're just investing through a trust, distributing all the income to yourself, because the tax outcomes would essentially be the same as you just investing in your own name. But you can distribute to a company, and the company pays the 30% tax rate. And so that's the structure that a lot of really wealthy people use to save quite a lot of tax. I might just take a couple more and then I'm going to circle back on these questions. So please, guys, keep the questions coming through. I'm loving seeing all these questions come through as well. Mayan says, is a sole trader a company? No, not necessarily. A company is like a PTY Ltd actual company. A sole trader gets you an ABN, but a sole trader is more for when you're doing like contracting work or freelance work or those sorts of things where you're actually generating business income rather than sole trader. You don't need to be a sole trader to have investment income. There's no benefit of actually doing that as well. Yeah. Hope that makes sense. Let me know if there's a follow-up question there. I'll take this last one from James, and then I'm going to circle back on crack on and circle back on the rest in a sec. James says, what would be the minimum amount recommended for investment under a company? It's a really great question. And it's the same answer as like company versus trust versus bond or anything else, that you want to make sure that the benefit that you're getting from any tax structure is more than the amount that it's costing you to run that structure. So when you want to set up a company for investing, you need to actually pay money to register that company with ASIC. And then you'll need to probably pay an accountant to set it up for you. And then you'll need to do a tax return each year. And that all costs a bit of money. It's probably, a couple of $1,000s or thereabouts. And so you want to make sure that the benefit that you're getting from having that structure is going to be more than a couple of $1,000s a year so that you're actually ahead. Hope that makes sense, James. All right, guys, keep those questions coming through, and I'll crack on and I'll try and make some good time to circle back on as many of those as I can as well. But I want to move on to the next piece, which is all about how to cut your tax bill, and something that's front of mind for people, particularly given that end of financial year is around the corner. And so, again, there's a handful of things that you can do here. The first one, and one that I see a lot of people end up not getting as much back in their tax as they could or they should, simply because they don't understand all of the deductions that they're actually entitled to claim. And so understanding what you can deduct and what you can't is really, really important. Now, the ATO have quite a lot of fairly helpful information on their website, so it's worth taking the time to understand that and know what you can claim based on your occupation. And then the second part of this is that you need to make sure that you're keeping good records so that you're actually getting the tax back. Because if you don't, have a good process for how you keep your records, then when it comes time to do your tax return, then you're scrambling, then you're going to miss things, then you miss out on deductions, then you end up getting less money back. So whether you want to be, there's a lot of apps and technology that you can use these days, or personally, I just like a spreadsheet, although my accountants use a bunch of the apps. But you need something, whatever works for you. Even a shoebox can work, depending on you, but you want to have something that makes it easy for you to track what you're doing with your expenses. Already spoke through those ones. Another one is getting advice and education expenses. So there's a lot of stats that show that average Aussie spending quite a lot of money each year, into the thousands of dollars, on their professional development and education. And basically, when your development is and look, I should actually probably, just before I get into this piece, say that this is not tax advice, and I encourage you to seek that out with the tax professional, essentially, just in case the ATO is watching. But when basically the big picture on the ATO's rules around education is that if you are doing any sort of learning, professional development, or formal study, and the main objective is to increase your income, then you're able to claim that's going to be tax deductible because you're essentially trying to build up your income. And so there can be some pretty hefty deductions that are on offer for a lot of people around this, and people often don't claim them. Now, advice is another area. So tax advice, investment advice, and financial advice. Depending on how it's structured and what the advice is for. Again, in a lot of cases, that can be completely or partially deductible, and that can help you to cut your tax and build your investments and investment income and actually get some more tax deductions at the same time. So yeah, some pretty big opportunities, particularly this time of year. You know, paying for these things now means that you're getting the deductions in before June 30. That can help with this tax time. Then you get the advice that can help you with next tax time and the tax times beyond as well. Another thing that you can do before June 30, particularly if you've had investments that you've sold that you may have made a gain from, if you bought some shares and sold them for a profit, if you bought some crypto and sold it for a profit. If you've got other investments that are sitting in a loss position, selling those investments and locking in the loss will offset the gains that you've got from your other investments that have made profit. And then that can reduce your overall tax income. And so June is a really good time to have a look at any investments that you do have in place. And if you've got any that are underperforming, as much as it's, we're all always often holding on for, those dog investments to turn around and, surely some good news is around the corner. Actually clearing them out can cut your tax bill for this year and boost your tax refund. So at least there's a bit of a silver lining there as well. Another one, and this catches people out every single year, is around private health insurance, because in Australia we have there's basically an extra tax that applies if you don't have private hospital cover health insurance in place and you earn over a certain amount of money. Now, it's the number, which I don't have exactly in front of me, but it's like 90 odd $1,000 for an individual, and around double that for a couple. Pretty much if you earn over the threshold and you don't have private hospital cover in place, you start paying this extra tax rate. It's called the Medicare levy surcharge, or so I think it's Medicare levy surcharge, which is different to the Medicare levy, which everyone pays. They use a little bit confusing terminology, but essentially it can be 1% or above 1% of your income, meaning that if you're on 100 grand and you're paying 1%, you're potentially paying $1,000 a year in extra tax. And so you can get a cheap private hospital cover, and oftentimes that will cost you less than what the actual tax is, and particularly if your income is higher. And so understanding that extra tax, making sure that you're set up in the right way is really important. But also know that how they actually calculate that tax is they look at how long over the course of the year that you have the health insurance for. And so if you get your health insurance on 30 June, it doesn't mean that you avoid the tax because you've only had it for one day out of the whole financial year. So this is something that you want to make sure that you've got in place for, particularly if your income is increasing into next financial year to over the threshold. You want to get this in place early so that you don't get slugged at the end of the financial year, basically. So those are the main things that you can do to get some quick deductions and pump up your tax refund. The next one that I wanted to cover is the tax strategies that you can use, or the tools that basically that are available to you to reduce your tax down even further. Now, the first one that I've got here is franking credits around, particularly around share investing. So basically, when you invest into shares, particularly into Australian shares, what you're essentially doing is you're buying a tiny little slice of a company. So you buy a share in the Commonwealth Bank, you own 0.00001% of the Commonwealth Bank, or whatever the number actually is. Now, when you own that tiny little slice of Commonwealth Bank, when the Commonwealth Bank generates a bunch of profits, it pays tax on the profits, and then it from its after-tax profits, it will pay out that money to shareholders in the form of dividends. Now, because that money has already been taxed, it's after-tax profit, then the ATO are kind enough not to tax the money again. And so essentially, when you receive your dividends, you actually get a tax credit for the tax that's paid by the company on the money or on the profit that you've received for your dividend. And so those tax credits can be really significant over time, because the company tax rate's like 30%. So basically, if you get a $100 dividend, you can get it's not exactly $30, but it's around $30 in tax credits that are attached to that $100 dividend. And those franking credits or tax credits, they can actually reduce the tax that you pay on your investment income, but they can also reduce the tax that you pay on your employment income as well. So really powerful way to actually build your investments, leverage the power of compound interest, and get you some tax credits on top. So definitely a really solid strategy worth being across. Now, when you're investing, I think diversification is something that's really important, which basically means investing into, some Australian shares, some international shares, some property or whatever. But there are some pretty big advantages of investing in Australian companies, and this is definitely one of them. Negative gearing. Now, this is one of the biggest tax strategies that are out there. Essentially, gearing means borrowing money to invest. So when you borrow money to invest, most commonly in Australia, that's done through property. And then when you're borrowing to invest, you're going to pay some borrowing costs, but you also receive some income on your investments. And essentially, the negative part refers to the cash flow of your investments. So to use a really simple example, if you borrow to buy an investment property and the rent is $20,000 a year, but the mortgage payments are $30,000 a year, then the cash flow of that property is negative because it's costing you $10,000 a year. And so it would be referred to as negative gearing. To put it on the flip side, that if your rental income was $20,000 a year and your mortgage payments were $10,000 a year, then you would have positive cash flow, and that would be called positive gearing. Now, the negative gearing works in Australia because you can actually claim the cost as a tax deduction, meaning that if you have an investment property that's costing you $20,000 a year, you claim a $20,000 tax deduction, and you're going to get, potentially, depending on what your tax rate is, but up to 10 grand a year back in your tax, meaning that it only costs you $10,000 to hold that investment. And you may be wondering why you would want to own an investment that's costing you money. And that's because only the cash flow is only one part of the equation. The other side is the growth on your investments. When you choose a good asset, you buy it at a good price, then it grows over time and you profit in terms of that growth. So it's a really powerful strategy. Worth noting that the tax benefits that you get from negative gearing, in my opinion, they're really the cream on top, rather than the reason that you should buy any asset or property to begin with. So where I've seen people go wrong is that they get so caught up on the tax benefits that they choose a shitty asset, and then the asset doesn't grow. And then they may have got some tax benefits for a period, but then the tax benefits run out. They're stuck holding some shitty asset, and that's a bad outcome. So powerful strategy, but never lose sight of the big picture, which is choosing a good investment. Investment bonds are another tax strategy. Really, really powerful. They're essentially one of those tax structures or entities that I was talking about before, but a really powerful way to build a share portfolio, cap your tax at 30%. And when you have an investment bond for 10 years, you hold the investments for 10 years or more, you don't pay any capital gains tax. So there's a big tax kicker at the back end, particularly for younger people. If you're trying to build your investments up, and you're taking a really long-term view, then, it's likely that you will be investing for 10 years or more. And so using a structure like this, essentially, you're not needing to change anything that you actually do with your investments, but you're getting a significant tax saving on the back end. Debt recycling is another strategy, and this one's really only applicable for people that own their own home. Basically, it allows homeowners to convert their non-tax deductible mortgage debt into tax deductible investment debt over time. And so essentially, when you own your own home, you don't get any tax deductions for the mortgage interest that you pay on your own home because it's just your own home. But with a debt recycling strategy, you can essentially convert that debt into tax deductible investment debt. And you do that by essentially paying down. To use a really simple example, if you've got a $500,000 mortgage and you've got $500,000 sitting in cash in your bank account, you can pay the $500,000 into your mortgage or pay $499,999 so that all but $1 of your mortgage is paid off. Then you take that money back out of your mortgage through a redraw, and if you get that money and then invest it into a share portfolio, that basically under the ATO's rules, or the way that the ATO looks at it, because the purpose of you borrowing the money or taking it out is to build investments. And so then that means that in the future, all of the interest on that debt is tax deductible. So that can mean that we've got an average mortgage size in Australia of about $700,000, 6% average interest rate at the moment. You potentially, by you following a debt recycling strategy, can be getting $42,000 every single year in tax deductions, meaning that you're potentially saving 20 odd thousand bucks a year in tax. And that's 20 grand that you can use to build your investments, pay down your debt even faster, whatever the case may be. Really, really powerful strategy. It is a complex one, and maybe I should have mentioned this probably a couple of slides ago as well. But with some of these strategies, that they are complicated. The execution, and I've tried to explain them in as simple a way as possible, but know that the execution does have a level of complexity with it. And generally, and I've seen people make mistakes with a lot of the things that I've discussed. It's not necessarily something that you want to do on your own. Because you can make mistakes, and they can be expensive mistakes as well. And then the last but not least, I've got super contributions. Old Faithful, look really easy. Everybody in Australia has the ability to make tax deductible contributions to their super fund of $30,000 every single year. That $30,000 includes any money that's contributed to your super fund by your employer as part of the compulsory super guarantee contributions. And so for most people, though, that leaves a pretty significant amount of room to make some pretty material tax deductible contributions, get a fair bit of money into your super fund. Now, I get that, if you're young and you're just early on in your journey, maybe you're trying to buy your first property or whatever, that you probably don't want to be chucking all of your money into your super fund. But given the tax benefits on offer for putting money into your super, plus the fact that once money gets into your super, it's taxed at a maximum rate of 15%, which is way, way lower than personal marginal tax rates. Doing even a little bit to build a habit around boosting your super and looking to increase your super contributions over time. It's a really solid idea, and I get that there's an element of distrust of super, and the government keep mucking around with the rules, and that's super annoying. But at the end of the day, you are going to be old and need money, and that's what super is there for as well. So it's a bit of a boring strategy, but it's also a very, very effective strategy as well. All right, guys, I can see a ton of questions coming through, so yeah. Appreciate that. Keep those questions coming, guys. Bridget says, what is the top amount that you can add to your super in 1 year? So that $30,000, that's the tax deductible contribution limit. On top of that, you can also put in after-tax contributions, so you don't get any tax deductions for them, but you can basically put in $120,000 a year on top. So, that's like 150 grand a year. And if you get an inheritance, or you've got, just falling over piles of money everywhere you walk, you can actually do 3 years worth of the non-deductible contributions in 1 year, meaning that you could do 360,000 bucks worth in 1 year as well. So there's quite a bit of quite a bit that you can do there on that side as well. Hope that helps, Bridget. Question here from Howie says, do you have a comparison table on debt recycling versus using cash to invest? No, I don't have a comparison table on that. But the benefit, I suppose, if you were to think about it, is essentially when you're borrowing money with a debt recycling strategy, you're essentially getting the debt converted from non-tax deductible debt to tax deductible debt. And so when you're paying your home mortgage and the interest rate is 6%, it actually costs you 6% to pay those interest costs, which sounds sort of obvious, but just to put it in context, when that mortgage is deductible, the true cost to you is not 6% because 6% is deductible, and say your tax rate 47%, just to make my maths easy, say it's 50%, then your after-tax interest rate is only 3%. So you basically got a 3% saving. And so if you're thinking about, say, $100,000 and doing a debt recycling strategy, or do you just invest it straight out of your bank account, that it's essentially the benefit to you, this gets a little bit technical, but is essentially the difference between the after-tax interest rate on your home mortgage and the after-tax interest rate that you'd get from debt recycling, which would be 3%, so $3,000 every year. But if you do that, say you do that for 5 years in a row, you do 100 grand a year for 5 years, now you're talking about $15,000 a year in tax benefits. So the benefits really stack and compound over time. So I hope that helps. I get that there was a lot of numbers there. Raj says, wouldn't the new Labor super tax affect super contributions? Look, not in the short term, and that policy hasn't been legislated, but it's looking likely like it will. But you know, no, in the short term, but depends on how your balance is building over time, whether they decide to index these caps on the for the higher tax rate, etc. But yeah, look, it's a concern. But given when the government start talking about all of these policies, I tend to just wait until we've actually got a policy that we can assess before we go changing strategies around that as well. Is the first home super saver scheme something we should invest in before the tax year ends? Lenora, that's actually a great strategy, and I've got that in an example to share with you guys as well. So I might actually just come back to that in a second. But yes, if you are looking at the First Home Super Saver scheme, and obviously this is not advice, and you should go and seek that out. But if you're wanting to use the First Home Super Saver scheme, then you actually get a benefit from starting it, at the soonest financial year possible because of when you can get access and how much money you can put in, essentially. So yeah, it's definitely worth trying to look at before 30 June as well. How long does the money need to be in the mortgage before redraw to qualify for debt recycling? It basically, it's immediate. So essentially, when you can put it back in, and as soon as you take it out, they look at the purpose of that borrowing, and so yeah, so it doesn't need to be in there for any period of time, essentially. And this is like 100% kosher, in line with the ATO's rules. I know because I spoke to one of the ATO's commissioners specifically about debt recycling as well. All right, I'm going to move on to this story. Keep those questions coming, guys, and I'm going to circle back to them at the end. I'm just a little bit mindful of time. I've got this story here, which actually gets into a little bit of the First Home Super Saver scheme. And so this is a couple that we worked with. Their income was 220 grand. They had savings of $130,000. They'd never invested money, but they were saving at a pretty solid clip, 4 grand a month. Now, they wanted to get into their dream home, or at least their first dream home in Sydney, which had a $1.2 million purchase price around it. They didn't have any family support, so they couldn't get like family guarantee or gifts or anything like that. And so basically, when they'd gone and run their own numbers and they looked at to get in this $1.2 million property, they figured that they were going to need 300 grand as a deposit and their costs to get in, which meant that it was going to be about 3 years away for them to get there. Now, what we ended up doing with them, it was around this time of the year, and they use the First Home Super Saver Scheme. Now, how that scheme works is that you can put tax deductible contributions into your super fund, and then you can take them out to fund your property deposit. But basically, because you can put the money in pre-tax, it allows you to, if you want to get, for these guys, they put in 15,000 bucks into their super fund, but it only really costs them like just a bit under, less than 10 grand to get that $15,000 into their super fund. So it allows you to build that deposit faster. And so when with the First Home Super Saver Scheme, that you can do $15,000 a year, but it's based on financial years. So they basically did one contribution around June. They did the next contribution in July. They had 30 grand in within like a 2 month period. And then the following July, they did another $15,000. And then they had $90,000 of tax deductions. $90,000 have gone into their super fund. They took it out, and then they used that to combine with their existing savings to build their deposit faster. They then build up their regular savings money as well, but we tweaked the strategy a bit so that they purchase the property at a lower purchase price after we went through the benefits of rent vesting versus buying a property as their own home. Because when you buy their own home, you're paying all of that mortgage with after-tax dollars. Then you also need to spend more, which was the case for these guys, that to get something that they would like, they need to spend 1.2, whereas to get a good investment property, then they need to spend 900. They lived in the property for 6 months so that they could still get the first home buyer benefits, but then moved out, got all of the tax deductions, and then could continue renting where they wanted to live. Basically allowed them to purchase their property 2 years sooner. So they purchased it in a third of the time that they thought that they could. Avoided lender's mortgage insurance, still got a $13,000 tax saving from the First Home Super Saver Scheme, plus a 10 grand uplift from their investments. And the kicker is that because they lived in that property, they then had triggered the 6-year rule for capital gains tax-free gains, meaning that if they sell the property in the future, they don't pay any capital gains on the first 6 years of their property ownership because of this 6-year rule, essentially. And so for these guys, that shows the power of just being a little bit smarter with the rules, but also the importance when it comes to property of really, I suppose taking the time to really understand your numbers and what actually will make the most sense for you from that perspective as well, because we got what we want to do, but the numbers don't always 100% line up, meaning that makes the most sense for you. All right, so shifting gears a little bit, I want to talk about some of the myths and mistakes that I see around property, and I'll just give you the quick version of these ones because I'm keen to jump into these questions. Staying in a low tax bracket is a really common one, which I touched on at the start. People think that when you go up to the next tax bracket, you pay more tax on all of your income, which is not the case. The next one is offset accounts versus redraw, and this gets quite complicated, but essentially, there is a difference in the ATO's eyes between when you have money you redraw money from your mortgage versus when you put money in an offset account as well. So when you have put money in an offset account and then you take it out of the mortgage, you take it out of the offset account, the mortgage was always preserved. And so where this commonly happens is that people will buy a property as their first home. They move into their home, but then they want to upgrade it in the future, and then they've paid down a bunch of their mortgage, but they want to redraw to fund their next property deposit, and they end up with this really low mortgage on their first property, which they want to keep as an investment, which creates a tax problem, and a really big mortgage on their new home, which is not tax deductible, and it makes a huge difference to the to how much tax you pay each year. And so knowing the difference, and I get that it's a little bit complicated, but knowing the difference between them and making sure that you get it right is really, really important. Some of the common questions that I get around tax, the first one is around who is the right person to help with tax. And I suppose I just wanted to flag that, In the past, it used to be that accountants were the only people that would really help with tax, and people would rely on their accountants to do this. But as the accounting market and industry has changed, that is becoming increasingly difficult, because essentially, particularly for individuals, for non-business owner individuals, that accountants are not really charging enough money to spend much time educating people, helping them really understand what's possible from getting your tax refund, bigger perspective. And they're not allowed to actually look forward about the investment strategies and a lot of the things that we've been talking about today around optimizing your tax moving forward from here. And so you want to be aware that you need to learn the tax rules a bit yourself. You need to at least know enough to know how you can set up your strategy and your structures. But when it comes time to like the sorts of strategies that we are looking at there with that couple, first home super saver, optimizing tax on their investments, those sorts of things, that's more of the role of a financial advisor who looks forward rather than an accountant that's just looking back after the end of the financial year. Another really common question I get is how to find a good accountant. Look, I think for me that the biggest thing from an accountant is someone that will actually educate you or provides you resources so that you can educate yourself. But asking, friends or colleagues, people in similar financial positions to you, are really is probably a big one as well. Because if they're working with people similar to you, then it makes sense that they're going to be familiar with the issues or the opportunities that are important to you. And then the last one is around, do you need a trust or a tax entity? And I love trusts. I've got a couple of them myself. A lot of our clients have as well. But as I touched on at the start, that you only want to have any sort of tax entities when you know that you're going to get a benefit from that in excess of how much money you actually pay for it as well. Cool, guys. Well, I'm going to crack into these questions in a sec. Now, I just want to leave you with this model that talks about getting from where you are today to future state with your money. And essentially, the model says that, in the future, you're going to be somewhere on the spectrum. Some people are going to be doing really well with money, others are going to be doing less well, and then a bunch of people in the middle. But when people think about getting from where they are now to future state with their money, they think about it like a straight line. But because of the compounding impact of time and money, it's actually a curve. And so if you're not 100% on track to end up exactly where you want to be today, you need to do some stuff to what we call jump the line. You need to be smarter with your tax. You need to start your investing. You need to, whatever those things are. And once you take those steps, then you just take the next step and the next step and the next step, which is easier because you're already on the path. But the thing is that the longer you leave it, the more time goes on, that the jumping the line piece becomes more and more painful, and putting yourself in the best position can become impossible, because it doesn't actually matter where you want to get to with your money. If your goal is that you have a passive income of $500 a month, $5,000 a month, $50,000 a month, then you need to save a certain amount of money today. If you wait a week, a month, or a year, or 5 years, all that means is that you need to save more and invest more to end up in exactly the same position. And so, look, no matter where you are now, the easiest time to start is now, and the longer you wait, the more you have to do to end up in where you want to be. So, guys, look, I hope you found that helpful. Look, if we can help, this stuff is our jam as well. So basically, that there's two different ways that we help people. I'm going to jump into these questions in a second, but we offer financial advice for people that want hand holding and do one-on-one financial planning. That service is ideal for people that want to cut their tax and invest and have some money that they can save every month to actually direct to getting ahead. And then we've got our Smart Money Accelerator, which is a digital advice solution for people that are still building up their savings capacity. So I've just popped into the chat a link for both of those. You can check out more details and get around them as well. I'm gonna jump into the questions now, and I'm happy to try and get through as many of these as I can until I get kicked out of this meeting room, basically. Let me just jump into this as well, and I appreciate all the thank yous in the chat as well, guys. Yeah, really appreciate that, and you're very welcome. Question here from Harash. Haresh, sorry, does a financial advisor also help with tax filing or only educates? No. So a financial advisor will not do tax returns. That's the job of an accountant. A financial advisor will do the tax plan, and then you execute on that plan with your investments and stuff, and then the accountant does the reconciliation at the end of the year. Got another question here. I've been thinking about joining the Money Accelerator for a while. Nice work. Can you please explain how much of the knowledge you shared will be in the accelerator? By the way, appreciate the knowledge and presentation skills. Oh, you're welcome, Marcelo. Yeah, we do have content like this, but it dives a lot deeper than this, where it's more the focus from the Smart Money Accelerator is real step-by-step instructions. I should actually say that we've just set up the accelerator to have the ability to have a free trial as well. I'll just pop that back into the chat as well. So you can do a free trial to actually see what the content looks like before you need to commit as well. So you just select the option for trial, but it goes a fair bit more detail and a fair bit more step by step to actually guide you through and make sure that you can turn the ideas into action and your plan as well. But look, I'm going to stay and keep answering a few questions. I appreciate that probably a few people have to jump off. Thank you guys. I appreciate all of the well wishes on the chat as well. And guys, check out our upcoming events as well, because there's a heap more coming up too. One here from Marta says, is there a super fund you can recommend that would allow me to make my own decisions about fund allocations via ETFs without an SMSF? Yeah, look, there's actually a bunch. I can't make a recommendation in terms of financial advice, but I think that Australian Super will allow you to buy shares and a bunch of ETFs as well. And I'm pretty confident that there would be a number of other ones that are really simple funds that avoid all of the extra cost of a self-managed super fund, but give you a lot of the control that you're looking for as well, because self-managed super funds are pretty expensive as well. One from Jazz says, can I claim the cost of a buyer's agent? Generally, yes, part of the cost. So that's a question that's best to actually run past a buyer's agent, because they will know. But typically, part of the fee will be deductible, and part of it will form like part of the cost base of the property as well. ND says, will the franking credit information be part of the auto-filled data in the ATO website, or is it something you need to get yourself? No, generally it gets auto-filled from the ATO, because all of that reporting gets in. It's worth double checking. You generally get a statement, and there's a lot of great tech things there as well that can support like ShareSite and these sorts of ones. Yeah, typically it gets pre-filled. One here says, is it just hospital cover for private health insurance? For the extra tax, it is, yeah, to hospital cover for some reason, not the extras cover. Not exactly sure why. Other fees to buy shares, stocks tax deductible too. That forms part of the cost base for your investments, and then factors into the capital gains tax calculation. So effectively, yes, it's just not that it's deductible against your other income. It's deductible against your investment gains and losses, essentially. Is education deductible if it's online? Yes, it can be, so long as it's meeting the ATO criteria around being tied to you increasing your income. Then that's generally the what they would need to be seen. Chris says, I'm about to buy some shares. Should I set up a company first and buy them in company's name opposed to my own name? Look, if the benefit to you is going to be worth more than the cost of the company, then that's when it's worth looking at. If you're going to do it buy $100 worth of shares, it's probably generally not going to be like, it's going to cost you more to set up a company than the tax that you save. But if you're going to buy $1 million worth or a couple of $1 million worth, then it would be a no-brainer to do it through some sort of entity, but really carefully considering whether you do that through a trust or through a company or through a bond structure even, will make it quite a big difference. And so before you just jump into setting up an entity, then you probably want to know that the benefit is there, essentially. Got one that says, in your experience, what is the best record keeping technique? Look, I think it comes down to personal preference. I like spreadsheets. I'm a spreadsheet guy. I've got a good spreadsheet for this stuff. That really works for me. But at the end of the day, it depends on what actually works for you. Go on here. How would the company pay you, or can you use the money from the company without it being seen as personal income? So when you invest through a company, what people will typically do is that they build up the assets of the company until they want to retire or don't have another employment income. And then you can actually pay yourself a salary for the company, but you choose to only turn that salary on when you've turned your other salary off, meaning that you're not going to get paid all at the top marginal tax rate. Essentially. So, uh, yeah, so that's why that people you through the building stage, you keep it there, and then when you're living on it, you can pay yourself a salary the other way as well. Guys, thank you so much for all of the questions. I love to see that as well. It's great to see so many of you guys keen beans and sticking around too as well. Look, guys, tax is a huge opportunity for a lot of people. Like I said, it's my favorite way to get ahead because it means not sacrificing and using the rules a little bit smarter to your advantage. And so, guys, we've actually got another event coming up in the new financial year about how to be tax smart for the new financial year. But do keep an eye out for our content because there is a heap that's coming up around this stuff as well. And, tell your friends. I'd love to see you at the next event. Once again, team, really appreciate all of the questions. Stay safe out there. Happy investing, and I will catch you next time. Cheers, team. Bye for now.